Okay, I don't want to spend a lot of time talking about due diligence. In a sense, a lot of the conversation that we just had, go back to an earlier recording if you're listening in your pajamas at home, has been about due diligence, really, hasn't it? The point I want to make is that due diligence is something that purchasers need to do as well as vendors. Because all of the things that you were talking about just now as being key terms that would be in a sale and purchase agreement, whether it's assets or shares, require identifying what the assets are, identifying where the encumbrances are, identifying who the parties are, understanding what your obligations are under material contracts. And so unless you do that work as a vendor, as a vendor as well as a purchaser, you're not going to be able to have the same kind of understanding of how the agreements work. And as a vendor, you will be on the back foot if your purchaser is asking questions you haven't asked already. Also, even if it's a pretty vanilla, straightforward arrangement, and the idea is just, there are 2 shares on issue, we're going to sell them all. It's very clear that everything is owned by the business, or owned by the company that owns the business. The purchaser is still going to ask questions, and the vendor is still going to have to put that information together. So often vendors start putting together a data room. We still always call them data rooms, I think, even though they're rarely physical rooms anymore. Back in my day, I sound so old here, but we did often have a room. There would be rooms, most law firms would have a series of meeting rooms which were dedicated data rooms. And effectively what would happen is you would put together all of the data that the company was prepared to disclose, and you would index it, you would put it in folders, you would lock them into that space. Sometimes it was the most boring job is that you had to go and sit in the data room while the purchasers were doing their due diligence to make sure that they didn't take anything out and put it in their pockets. Like, this is pre-mobile phone, and pre-digital cameras too, that's how old I am. There were no portable scanners or any of that kind of risk, but we would check people's bags for cameras that they didn't take photos and stuff like that, because you wanted to keep that information confidential. And also when you've got competitive tenderers and you've only got physical documents, then sometimes people will take away interesting information that they don't want their competitors to see. As a junior lawyer, you would just have to sit in the room and watch. And the first time I did that, of course, I just sat in the room and watched. And then afterwards, the partner is asking me, so what were they most interested in? It's like, idea, but that's because, of course, that's kind of indicating to the vendor where we're going to have most discussion around warranties, etc. But
these days we track it for the audit trail online, so we can actually see how often they're accessing it and downloading it.
One of the many, many ways that the role of the junior lawyer is being replaced by automation is in the automated data rooms. So, and basically that is as much information is uploaded, it's indexed, it's categorized, and we can use that software to see what people have looked at. In fact, software is getting really clever now too. It can look for unusual trends in some cases. And I've found as a transaction lawyer, I've used some high-level data room transaction software a number of times for writing agreements as well, because what I can do is just use it to upload a whole lot of similar agreements, say a confidentiality agreement, and then be able to see trends across those different agreements to come up with something that I think is going to work for that particular industry or otherwise. So they're quite good. So due diligence involves vendors and purchasers, we've spoken about this a number of times, we tend to work to materiality factors. So very similar to when we're looking at an IPO due diligence. Even though we might not have a due diligence manual or charter as such, because due diligence is just being conducted by the purchaser, it's rarely a committee of the board, it doesn't have that kind of status, but you will report by exception. So you will be looking for the kinds of issues that you're looking for that are going to have a material impact on something that you are interested in. So the clients will need to instruct you in relation to what they're really interested in finding. And generally we report by exception. So we don't summarise every single contract and tell them what's in those contracts. What we do is we identify the ones that have problems or concerns that they need to know about. So, okay, we'll just given the conversation that we've had at the moment, say looking at material contracts, what kind of things do you think a due diligence report might comment on in relation to just looking at contracts, given the kinds of things we've been speaking about earlier? You guys know I'm good with the silences, don't you? You just like, you wake me out.
I will start with the part that I have actually done.
Good. What have you done?
Tax.
Tax. So what, with contracts, so what are we looking for in relation to tax?
We are looking for material risks that the commissioner will make an adjustment and that the purchaser will be liable for that adjustment. We often comment on warranties and indemnities, whether they would be sufficient. We are looking for things like...
Well, the other way around too, there is, you're commenting on the warranties and indemnities, but before that, somebody is putting warranties and indemnities in. Now, you guys are starting with a precedent, right? But it's a catch-all, one-size-fits-no-one kind of document. So you would be looking, as you do that due diligence, and again, this is typically finance or the accounting firms will do that kind of they'll be looking at what the tax returns have said in the past and matching the tax returns against the supporting evidence or contracts. And then somebody will be saying, yeah, that looks a little bit iffy. Let's identify, it's a technical legal expression, iffy. The accountants use something highbrow, but we just say iffy. So they will be reporting on potentially contentious transactions when it comes to tax.
And things that we think have strong evidence, so they'd be what we call green. So all the tax returns have been lodged, great. But we think there's some transfer pricing risks here that haven't been dealt with, so that's in red. Yeah.
So again, exception reporting is quite often we use traffic light reports. So the physical documents, so you will start off with a list of questions and the supporting evidence, and literally we'll put green means no problem. So, and that's the advisor making a call on that. So right at the beginning of the due diligence process, the professional advisors allocate the work between them, because of course, as an advisor, if we say something's green and it turns out to be red, if we tick, no obvious issues here in relation to trademarks, and then it turns out Daimler Chrysler doesn't own the Mercedes mark, there's a law firm or somebody who did that due diligence who didn't identify that potential issue who also may have a claim made against them. So, but just going back to just contracts, looking at the contracts that are already in place. So say the leases, for example, what kind of things would you be looking for in premises lease? Term, when they're going to expire. Does that match with what our plan is? Make good. So do we have to, when we leave the premises, fix them? Just given what we said before too, change of control. One of the first things you're going to look at across all of the contracts is there a change of control provision here? Is there something that we need to fix up? Supply agreements, what kind of things might we look at with suppliers to us? Change of control maybe? Potentially, we might also look at exclusivity. So if there's a particular widget or if there is a particular thing that is really difficult to get hold of, I had a client once who bought a technology business. This is back in the 90s. It did facial recognition, really early stage facial recognition. But it was the system was built into particular cameras. And it turned out that there was a particular piece of hardware that had to go into the cameras, that there were only 5 of them in the world. And there was only one supplier. They had stopped building them. So again, the contract itself, so they were just ad hoc contracts. But if the due diligence had been done properly at the beginning, part of that due diligence would have been, is there any specific widget that is hard to get? Should have come out as part of that process. If you have a business or client or a transaction where there are multiple contracts, so for example, think about buying a shopping centre. No, actually do it the other way around. Buying a franchise or a group of shoe shops. So think of shoe shops that are all in different shopping centres all around the country. It is likely that every set of premises that aren't owned, which I'm thinking for a shoe shop is likely to be most of them, will have a change of control provision in it. One of the things that the due diligence should do is identify which are the most important of those stores, and there will be a kind of materiality threshold. So if we think there is a risk that we won't get 80% of the shops to agree to this shopping centres to agree to this transfer, then we would definitely not go ahead with the deal. But if we're getting 80% of them agreeing, we might still go ahead unless the 20% include our key stores. So due diligence is often about not just reading contracts, but putting the contracts into the context of the business. And I know I'm a bit of a due diligence nerd. I know it's not sexy, but I actually really like due diligence. I've always liked going through all of that stuff to get a really solid understanding of how a business works and really trying to understand what's important to the business. I find that particularly interesting. I know, there will be lots of junior lawyers who eye roll about it and think just reading contracts over and over again, so boring. One of the things I think that's great about advances with legal technology is we are now getting, it's much easier for us to search for keywords or to get AI to compare contracts and to bring out some key themes so we can go into what it means much quicker. We used to have to spend hours and hours and hours of time reading the contracts. But I have to say, I learnt a lot about how commercial deals were done by reading many, many contracts over the years. And it does, I think, beg the question of how you guys, when you go into practice, do learn those things. And because much of that work is disappearing now, which is one of the reasons I'm kind of encouraging you to look at precedents and to use contracts as we go through this. Having said that, the kind of legal work that will be done in 10 years' time is quite different from the work that's done now. And so the way you learn how to do that future legal work is going to be different from the way I learned to do the work that's done now, starting 30 years ago. So I'm not worried about it.
Can I say something really, really rude?
Please.
Yes, and it may not have.
I hope you swear.
No.
Do you want me to pause? Would you like to chat a mouse rule it?
Yeah, just pause it.
Sorry, guys. We'll be back in a second.
What AI we can do in the future is pick up what clauses are just and pick up the things that are different.
Well, and what it is doing, what AI is doing now is identifying the things you need to look at. And I actually see this as opportunity for you guys because you will spend more time as a junior actually having to apply your common sense and what you think about an issue and asking questions than just actually going through and ticking. I spent a lot of time ticking things off and crossing things out. So I got to read those contracts, but you got to read a lot of them that are very, very similar, where if you can go straight to this is different, how and why is it different, is a much more interesting thing to be dealing with.
And you want to add value for your clients. If a computer can do it, then they shouldn't be paying $1,000 an hour for a lawyer to do it.
No, exactly. So I think the issue is more about how we learn to do it, and I'm not sure how that's going to be solved, but I think how we learn to do it is you are going to learn differently from the way I did. But also, we didn't have classes like this when I was at university. We just had talking heads just telling us stuff, and you didn't actually get to look at documents or interact or think about how it fitted into the real world. So, I think we are changing the way we learn. So due diligence has a purpose, and ultimately a large part of that goes particularly for the vendor to this question of warranties. So, geez, a bit of a delay, isn't there, when I draw? But anyway, so warranties. Sorry? Yeah, we are recording. I turned it back on again. But thank you. Thank you. So warranties. So one of the things that due diligence does is inform us in relation to the warranties. As we identify issues that arise, we then need to work out how to address them. So asset sales in particular, warranties will work in different ways. It's quite common to just have a disclosure warranty. So where it basically says, you take this stuff as it is, and we've opened up the information to you. You can have a look, but we're not giving you any warranties. So what we're doing, so we will warrant that we have answered all of your questions to the best of our knowledge, information, and belief, and that we haven't withheld any information from you. But it's basically up to you as a purchaser to kick the tires, count the stock, look at the numbers, and come up with what you think is the deal. Alternatively, a purchase, so that's probably a vendor's best case scenario, right? That's what a vendor wants, is like...
And normally I don't even see it with calculations. Normally it's just everything we're doing US true, correct? You normally don't warrant.
You haven't withheld.
Well, because you're saying it's your job to ask the right question.
Yeah. Well, yeah. And a withheld clause is written pretty carefully. It's like, in sense, it says, we've answered the questions that you've asked. So that's... The other way of expressing that is we haven't withheld any information that's known to us. And you usually, as a draftsperson, you're looking at that language very carefully, because we know misleading and deceptive conduct. Conduct can be misleading or deceptive without any intention to mislead or deceive. So we're very much tying, a vendor will very much want to tie their obligation to, I knew about this thing, I had a record of it, I handed it over. Like, if it turns out that, a expert in tractor tires would have noticed that this kind of particular tractor tire testing hadn't been done, I didn't tell you I didn't do it because I didn't know about it, I didn't care about it, you didn't ask me about it. That's fine. Where on the other side, a purchaser, so given that's what a vendor wants to do, is just say, yep, all I'm going to do is promise you that I've answered your question. And the answer might be, don't know anything about it, didn't keep the records. Doesn't matter. If that's what a vendor wants, what kind of warranties does a purchaser want? Are purchasers happy with that? Nope or yep? No. Why not? ultimately contracts are about allocating risks, aren't they? So with a kind of warranty regime that is, the only thing I'm going to promise you is I told you the truth when you asked me a question, then the vendor is restricting their risk to an employee lying or failing to hand over information when asked, right? That's a risk most people, especially in a family business, will feel pretty comfortable about, right? Where the purchaser's risk then is, what if we didn't ask the right questions? What if when they didn't hand over complete information, the assumptions we made were incorrect? Effectively, that's allocating a lot more risk to the purchaser. And warranties in particular are just about allocating risk. So a purchaser's ideal situation would be a listing of every single asset that has ever been there with a corresponding warranty that it is in full and complete working condition and that it's never not been serviced by the provider of the machinery, you know, the original equipment maker, and that it's only ever been, the cars have only ever been driven by Nana to church on Sundays. And
I saw this on $1 million
every day at Caroline Health.
Sorry.
I saw this on $1 million asset purchase once from the buyer solicitor's side of the deal because it was just so OTT, so over the top.
Yeah.
Everyone threw up their hands and said, you either need to change the way you approach your business.
So, and look, and I mean, I'm being ridiculous, and it's quite rare to get either of those. In fact, I've never seen a full set of warranties like what I was trying to describe then. I've never seen it. I have seen on the vendor side quite often because, again, there's a cost involved, right? So, again, with allocating risk, we're also allocating costs here. Costs associated with making those inquiries and creating those lists and making sense of them at the beginning. So that's one of the reasons why due diligence is often by exception. Like, I want my advisors to look at this stuff, but I'm only interested in things that are going to cost $1 million or more. Or I'm only interested in the machinery that I'm going to use in the new business. The stuff that I don't care about, right? That's how it is. So effectively, vendors need to assess the warranties they can give. So particularly if they're being pushed, due diligence is a useful part of that. Purchaser is assessing the risk. So, and remember that a warranty and an indemnity are different things. So warranty, the language comes from, again, we've spoken about this in contract law. A warranty is a particular type of contract provision. We tend to talk about three, I know contract is all about classifying provisions, right? But we have warranties, conditions, and then inanimate or intermediate terms. So what is the difference between a condition and a warranty?
Breach of the warranty doesn't entitle termination.
A breach of a warranty doesn't entitle the affected party to terminate the contract. At best, it entitles that party to claim damages. Where if a term is a condition, it allows one, regardless of how important or devastating the breach is, it might be only minor, failed to get finance on terms that were sufficiently acceptable to the purchaser. They might have got terms that were acceptable to just about anybody else but weren't sufficiently acceptable to them. If it's framed as a condition, and that's why we use that term condition precedent, it's actually to remind the lawyers in the room that that means that deal's off. No deal, terminated. Warranty, on the other hand, gives right to damages. But I said before, at best, right to damages, because again, depending on how the deal is structured, it is likely that there will be a clause that provides caps and collars for the damages. So there will be a provision that says, because you've got all these warranties, so warranties are just promises. I promise that I told you everything that I told you was true, and that I answered all of your questions to the best of my information and belief. That's just a promise. So what happens if that turns out not to be true? So you can sue for breach of contract. Then we've got to do a damages assessment, etc. So what is usual in these kind of transactions is to say, if any of the warranties turns out to be untrue or incomplete, this promise, you haven't actually kept that promise. By the way, warranties are usually required to be true at the date that the document is signed and the date on which either the assets or the shares are handed over. Okay, so we usually pick those 2 dates. So if on either of those 2 dates it turned out those things weren't true, then usually you will have a provision that says when the total amount of damage reaches a number, $10,000, $100,000, $4.50, doesn't matter. It's that's our first cap. So our first collar. At what stage do we actually can we make a claim? Then we can make a claim for a breach of warranty up to a maximum of X. And often how that will be managed is that part of the purchase price will be withheld, either put in trust with somebody if the parties don't get along or appear untrustworthy, or it might just be a later payment will be made and the amount of damages will be offset then. Or there might be an insurance policy in place. So due diligence is actually critical to understanding that. And so often the percentage that we use for determining what will be a material due diligence event will be relevant to determining or be determined by the caps or collars for due diligence. So that was actually the why is this not working? It's because I'm trying to draw on the slides at the same time. I need to just get up here. Should be there. So I just wanted to, my plan was to ask you quickly here what we were going to do with the due diligence information. We have already spoken about building warranties. We have spoken about it from the point of view of actually adjusting purchase price. Just quickly, is there anything else that you guys think due diligence information would be useful for a purchaser in particular?
Strengths on employees.
Yeah, working out who they're going to keep. Absolutely. Who are the good employees? What else? Renegotiation, absolutely. So that can be adjustment of the purchase price as well, but the more you know about the asset or the shares, the greater your understanding is of the encumbrances that are attached, the more likely you are to come back and say, well, I had this indicative number, now we need to renegotiate with a little bit more reality. I like using due diligence for future business planning too. So these are now, I've got that information. This is how they do it. This is how we do it. When I put those two business units together, what can I learn from this other company? What can we already do that is better? Where are the efficiencies? And I think that's the stuff that often gets lost when the due diligence is done largely by outsiders, by advisors, because it's too expensive to get advisors. And you, quite frankly, with no disrespect to anybody in the room, but lawyers don't necessarily make the best people for advising on how to run your business smoothly. I don't know if any of you have worked in a law firm, but they're crazy run organisations. So not entirely sure that that's the best way. But when you've got, that's one of the reasons why there is real value in having members of the management team actively involved in the due diligence. One thing that they're doing is they understand their business or the industry, and they understand intimately what the purpose of the transaction is. So they are on the lookout for things that are going to achieve that purpose or defer from it. They also understand in relation to warranties what really matters. And the thing is, negotiation is about giving and taking. So if you are in a position where you understand which bits of the business from the due diligence your client really cares about, then you've got kind of throwaway warranties that you can give on if they don't care about those things. So, again, I know I'm a fan of due diligence. I don't know why I'm trying to convince you, but here we go.
I'd just add as well from a vendor perspective, when they do their own due diligence, it's a really good opportunity for them to try to rectify issues before the sale.
That is a really good point, and one that I should have made, that often you do see, and we did talk about in the context of due diligence leading into an IPO, often a lot of the due diligence is about eradicating risks or issues so you don't have to disclose them in the prospectus. We talk about it as due diligence, but it's actually due diligence plus the transactions we need to eradicate those issues. But as a vendor, often what you're trying to do is offer the cleanest package that you can, particularly if you're not selling all of the business and you've got an ongoing stake. And particularly if and I've used this term a couple of times, but if the price is structured as an earn-out. So an earn-out is where the price is calculated in part based on the future performance of the business. So that client I was mentioning before, who had the 25 and it turned into 50% and then 75% sold to, she's current transaction, so I won't give you the name, but to a large listed company, he also had an earn-out provision in relation to the price of those shares. So they can be quite fraught to negotiate, but effectively the price that he received for the shares was based on the earnings of the company over the 12 months, from memory, after the shares were transferred. So he got a base price, let's call it $1 a share, and then and that represented no less than, from memory, 50% of the balance of the amount owing. So and adjustments might have been made downwards on that. Actually, I don't think they could be made downwards. It was a pretty good deal. He got at least $1, but if the company, if the performance was, I think he got at least $1 if it was 80% or less. Between 50 and 80% of projections, he got $1. At 80% and above, he got, I think, 80% to 100, he got $1.20 a share, and over 100, he got, I think it was 75% of the uplift on the first tranche. So he basically got to keep the additional amount. In exchange for that, he had to continue running the company. He wasn't allowed to change any of the business plans from a budget that had been set without the approval of the purchaser of those other shares, particularly more relevantly later on when they had more percentage. They weren't allowed to change the board constitution, and they're not allowed to withhold treasury funds. So they had an internal loan arrangement, so they weren't allowed to require dividends to be paid out that would otherwise have been reinvested into the business. So you can see with an earn-out, and earn-outs can be worked in many, many, many different ways. I'm just using a relatively recent example because I've had to look at the earn-out provisions recently for another purpose. But they can be organised in any way, but you can see how the due diligence is particularly important to that, but also the commercial terms follow through. If the amount of money as a vendor you're going to receive depends on what happens after you cease to have control, then you need to know that it's going to be run in the way you expect it to be run. Because if your purchaser is motivated to make less money early on because they only have to pay you more money, then they may not continue the business in the same way. So you're wanting to maintain control in those circumstances. Okay, I would like to talk very briefly about structuring before we go to lunch. So I'd like to head to lunch at 12:30 if that's working for you guys. So structuring really comes down to, now you guys have already, I've told you whether you're shares or assets, but I want to talk a little bit about why we do shares or assets. And we did actually cover that off to an extent. So I think first time round or first weekend round. Couple of things that are constant. So if we are talking about a sole trader, a sole practitioner like a law firm, or a solo accountant, solo accountant less likely, but you never know, or a partnership, it's always going to be an asset sale because we don't have a corporate structure to sell, right? So we go straight to asset sale. We don't have an option. But when we're talking about anything that involves a corporation, then we have a choice, in theory at least, between structuring it as an asset sale and structuring it as a share sale. A few different factors that go into this. Some of them are commercial, so the kind of things that we've just been talking about. We know if we're buying shares that we're getting everything, or we should be, and our due diligence at looking at the assets is making sure that everything is relevant, is actually owned by the company, and anything irrelevant is disposed of by the company before we take control. Conversely, with an asset sale, we need to actually physically identify all of the assets and everything that needs to be novated, identify anything that has to be registered. So if the assets include real estate, for example, we know that we are going to have to actually go through a written process and a registration process in order to make sure that the real estate is properly transferred. Where with a company, it should be easier to do that. The number of third-party and corporate consents, you're always going to need them all. Any contract that you need to novate that is material enough that you need to novate or change it, you are almost always going to need to get that third-party consent for all of them in a asset sale, where in relation to a sale of shares, you might actually just decide to only seek the material ones, the most important ones, and take a risk that the others will say no. It's actually pretty rare for particularly small suppliers are happy to sell to anybody. So if they think that they can sell to you, they're happy to do that. But yeah, again, it is a slight risk. It can go to deal process and timing. Which do you think is quicker, selling shares or selling assets? Usually, because once you've got the bundle, you basically, it's, everything's in Santa's sack and we're heading, we just basically throw that over the other end of the table once we're sure that everything's in it. It's pretty quick. But when we've got lots of different assets, particularly if we've got ongoing contracts that require approvals before they can be transferred, or lots of real estate, lots of employees, can be quite difficult. Yeah. Well, actually, let's talk about employees for a minute too. That it is, again, I am not an employment lawyer, but often the employment law elements are the most strategic and some of the most time-consuming elements of negotiating these transactions, regardless of whether it is a share or an asset transfer, because there is so much legislative intervention that impacts the nature of contracts. So even though theoretically with an asset transfer you should have new employment contracts, it is quite likely, particularly if there is an EBA in place, but just quite likely generally, that the person who is assuming those contracts will need to also take over long service leave and other accrued benefits, sick pay, etc. Because it's kind of not fair for somebody to be working for somebody for a period of time and then suddenly they've got a new owner and all their sick pay and holiday pay and their accrued entitlements have just disappeared. So there's legislative interventions that require for those transfers to happen. Also, even though in theory a purchaser with an asset sale can go around and say, well, I want him, but I don't want her, again, the law will intervene in relation to unfair dismissal, even though it's on a transfer. We'll actually look at whether or not it's actually a redundancy as opposed to a choice. There's a range of different factors that interface there.
And you shouldn't assume as business that the staff have employment contracts. Sometimes
That is actually a really good point. You should never assume, actually I think even in a big business, you should never assume that there are going to be employment contracts or that the employment contracts will make any sense. So one of the things that we're often looking at, I know I'm going back to due diligence, but that purchasers will be looking for sometimes called poison pills or golden handshakes. So where particularly sometimes a family member, but not only. So I've often seen CEOs or important, often sales directors in smaller businesses have provisions in their employment contracts that effectively give them the right to a payout if there is a change in control in the business and they don't want to go to the new employer. It's not at all unusual. Similarly, it's not at all unusual for there to be nothing in writing. So any Mad Men fans, we call it the Don Draper. It's like, remember, part of the whole plot in that series, which at the end of the day is just a show about mergers and acquisitions, if you want a little bit of procrastive viewing. Mad Men, effectively, they just keep buying and selling within the agency. It's all about M&A. But Don Draper, lead character in that show, one of the ways he maintained control was by refusing to, for a very long time, to enter into an employment contract. So it's not at all unusual to see.
Can I just make a comment about assets and shares? As an advisor, I always want shares. It's just easier.
Yeah.
But when you've actually got to think about what's best for the client, we're often going to be recommending assets because you don't want that history necessarily. So it's a funny little tension.
It is a funny little tension, and it's in fact, you lead me on perfectly to the next slide that I want to show. No. Is looking at this now. I think that the pendulum has very much swung in the direction of share sales. I'd be interested in those of you who are in the space whether you agree with that. I'm seeing very few asset sales now.
what transaction size are you thinking of?
Probably over 5 mil.
Yeah, so I think under 5 million you're going to see a lot more asset sales.
Yeah.
And under $1 million it would be rare, extremely rare for it to be a share sale.
Yeah, which actually completely makes sense from the point of view of one of the biggest reasons why shares have become more popular is that ultimately the vendors pay less tax because of the way capital gains tax works. So at risk of completely oversimplifying, if you own a capital asset for more than 12 months, you pay half the rate of tax that you would if you pay for under 12 months. Now, with businesses, if we're talking about a business and asset sale, you've got individual assets, which you might own, they'll be, the tax becomes very complex, but you've got individual assets, some of which might be very high value, and if you are realising those assets at a profit, you will pay, if you've held them for more than a year, a lower amount than otherwise. But often businesses write off their assets over a period of time, and effectively the difference between the value of the assets and the price is goodwill. And goodwill will be taxed at your personal income tax rate. So if you're and again, I'm oversimplifying because there are definitely things you can do, but I just want you to understand the motivations here. I don't want us to get caught up into the myriad of different options.
I've got a simpler way to say it.
Okay, please. How good is it, by the way, for you at home that we have somebody from the tax office here?
Don't say that. I used to be in practice.
Yeah, used to be in practice. Sorry. Chatham House rules.
Shares all on capital gains. So, as Kath said, you might get a 50% discount. Business, you've got a mix of assets. There might be some that are capital assets and might get the 50% discount, but there's also revenue assets, and you won't get any discount on that.
Yeah.
So you're going to pay more tax.
Absolutely.
Yeah.
So, and again, that goes to that. How much what vendors are interested in, on the whole, please tell me if you have a different view here, is how much money they're going to have when everything is done, including paying their tax, to invest in their next opportunity or go and live in Cambodia, whatever it is that they want to do. So when you are paying less tax, if it's structured in a way you can pay less tax, there is room to negotiate on price because you can get closer to how much money you want to how much money they're prepared to pay can match in this easier way. So there is negotiation there. Also, from a complexity point of view, transaction complexity, it's quicker, easier, costs you less for advisors. Purchase, for a share sale.
So I disagree with
Oh,
that.
okay.
At the lower end, I disagree with that. So if you have a $2 million transaction, it's going to cost a lot more to prepare a share sale agreement to get it agreed.
Again, actually, I will concede that point because I'm thinking about $5 million and up because that tends to be. I mean, there are many, many transactions where you don't see a lawyer, and the kind of transactions that you are likely to get yourselves involved in, because that's the other thing at the lower price range. The lawyer is likely to be a solo anyway. As a junior, you are unlikely to be working in relation to those kinds of smaller transactions. They need to be kind of big enough to justify it. But I mean, that might change.
I think there's definitely trends.
But
that they will get lawyers involved. But again, it is only that very minor end. We're not talking about massive.
And they often get their accountants involved.
Yeah.
Like most small businesses will have an accountant. Their accountant will be their trusted advisor, absolutely. And the accountant may well be, in many cases, the only advisor in relation to a trade. And they will trust their accountant to put their hand up when a lawyer needs to be involved. Yeah. So that's part of it. I just want to circle back to Michael's point just now. Why do you think, I'm going to ask Michael not to answer, but why do you think that the costs for the client would be higher for a share transfer when the deal value is low than an asset transfer? Because of the due diligence. Because when you get everything, that means you get the bad news as well. And so there is a much greater need for the purchaser to understand the risks attached to the liabilities, encumbrances, etc., than there is if just they're saying, I want that, that, and that, and you need to sign a piece of paper that says, I can continue to operate this business under that name. We'll do a couple of business name transfers and off we go. And you are left with what, if you owe somebody money, that's your problem, not mine.
And the risk in a smaller transaction of that is actually larger because the capacity of the buyer to do proper due diligence is lower.
Yeah.
And then the actual contract itself becomes much more dragged out in the negotiation back and forth between the solicitors. So, we find that it's much longer and much more costly.
Yeah, exactly. So, again, thank you for pulling me up. So, basically, what we have to think about with a business and an asset sale is what is going to go in the deal and what stays outside of the deal. And I just put some examples there, and I'm not going to spend a lot of time sitting on this slide, but a lot of this comes out of the due diligence. And as you get more experience, and this is why advisors are often chosen based on their experience with a particular industry, Like you would rarely go to a firm that had never been involved in the sale and purchase of a franchise before if you wanted to buy a franchise, because you know that they have experience with similar types of businesses. And often you find, so firms that deal with franchises all the time tend to either work with franchisees or franchisors, and the franchisees will often all use the same law firm even when they're buying and selling. So there might be 2 or 3 firms that deal with the buying and selling because they all know what the contracts look like already, what the issues are. So we can end up with some conflict issues, but they all seem to manage that. So again, what the things are that you might be wanting to move into the business or into the agreement will really just depend on what's going on. One of the things that we haven't really spoken about very much is existing litigation. Now, in an asset sale, we probably want to keep that out, but not always. Can we think of a circumstance where, as a purchaser, it might be important to you to have some influence in or control over the outcome of some litigation that the business is a party to?
The claimant in that litigation?
Well, if the business is a claimant, that would mean either the humans who own the business or the company that owns the business would be the claimant. And so if you're thinking about like insurance or there's a amount of money owing, the way of you could, I mean, if that's just money, I think that's pretty easy to keep out. Just trying to get you thinking about, well, when you're looking at what kind of litigation there is, what kinds of litigation would you be really concerned about the outcome for? Employee related, particularly if it's some sort of action to restrain somebody from doing something that could negatively affect the business. Anything to do with IP. So if you use IP in your business and somebody claims that you don't own that IP or that you don't have the rights to use that IP in some way, well, that's the sort of thing that can kill a deal. Our robot deal, I'm thinking, it's likely would be commercially dead if the IP we want to buy, if somebody is already suing to say that they don't own it. But we might want to, if we were prepared to go ahead, we might want to be able to influence an outcome there, or be able to, particularly if we wanted to settle it, for example, we want to go on, or it might be that a vendor wants to settle and we need a clear ruling in relation to something.
Is there any benefit from having you take over that litigation and resolve it as opposed to the previous owner?
Depends on what it is, but yes, that's what I'm really talking about. If there is a benefit in doing that, then that might be what you want to do, which would actually, how that works is you would effectively need a contract with the party to the litigation that you can effectively stand behind them. You might be funding it, but that they're effectively going to take instructions and do what you ask them to do.
Thinking if you're both trying to achieve the same thing with that litigation, wouldn't it be better for them to see that litigation out?
If you're both trying to achieve the same thing, but often when they're no longer in the business, they just might want to settle it and go away. So it's about, and that goes to the nub of what the question is in relation to litigation and where it sits. So again, we kind of got the opposite issue when you've got a company sale, is you'll have everything in here and you'll be trying to work out, well, what goes out? Should the litigation move out instead? So again, really just coming back, I did confess early on, didn't I, that there's no real magic to this. It's all about understanding how the contractual relationships work. So, which is better? I think we've spoken about all of those things. It will really come down to negotiation as to which is better. As I said, I think in the sort of $5 million and upwards category. In fact, thinking about it, the last couple of business sales that I've been involved in have been probably around the $7.5 million. So it might even be a higher number than that. But I'm not seeing very many, particularly in the tech space. It's quite rare to see asset purchases. And on the whole, too, in the tech space, another thing to take into account would be it's actually quite difficult for tech companies early on before they have customers to borrow money. When you have a business that makes physical things, you tend to have machines and stock and stuff that is easily valued and is able to support borrowings, where when you've got an idea and you're just building software, it can be quite difficult to borrow money. So tech companies, even though they don't want to be, tend to be pretty clean. They tend to be relatively debt-free and really are just people, and in fact less and less even hardware these days because they're using cloud services and they've just got contracts. So on that note, I'd like to come back and we'll start working through the actual auction process with your agreements. I'm going to print out a couple of those agreements so you can look at the physical copies over lunch. I'm going to print them out over lunch. I don't expect you to look at them over lunch. That includes you at home. Take a break, stretch your legs, eat something, and we will meet at 1:20. Does that suit? Just under an hour? Thank you. You take a break as well at home.